welcome to this FTI Treasury Talks, where we're going to be discussing some of the key decision-making factors when looking at implementing a liquidity or pooling structure for your organisation. My name is Justin Callahan and I'm the Chief Executive of FTI Treasury, and I'm delighted to be joined this morning by Eileen Murray, who's one of our managers in our front office operations here, and Shane O'Keefe, who is our Head of Innovation and also manages our back office operations. The purpose of today's talk is really just to have a look at many of the key things that an organisation should look at when looking to implement a new liquidity or pooling structure. We're lucky enough here at FTI Treasury to have over 30 years experience in managing pooling structures and implementing them for clients. So we just want to bring a little bit of our experience in that regard to you this morning. So with no more delay, let's get into the conversation. I suppose, Shane, we manage a huge number of pooling structures on behalf of clients. Before we look at some of the sort of decision-making factors that go around looking at which is the correct one, what are the common structures that you tend to see that are implemented?
Across the clients that we currently manage, the most common structure would be a hybrid between a multi-currency notional pool and a ZBA under that. We do have around 40 ZBA structures across 20 banks currently that we manage, and then we've around a third of them have a layered multinational currency pool above that. Then we do have a few outliers as well, where we might have a virtual account set up and some Scandinavian cash pool structures, but in the main it is more a ZBA with a multi-currency notional pool.
So it's interesting that with all of the kind of advances that the banks will have us believe have been implemented in recent times, actually it's still one of the more basic structures, the zero balancing arrangement, that is still probably one of the most popular. Would that be fair to say?
Yeah, it's just the easiest to manage and implement.
Yeah,
really.
interesting. And virtual bank accounts and all that sort of stuff, are we seeing much action in that area? Or?
It was the buzzword a couple of years ago, but it just hasn't seemed to have got much traction with the clients that we manage. The ones that we do, it's just not as seamless as the old-fashioned ZBA notional structures, and it maybe in years to come, but it still probably has a few teething problems.
Interesting. And tell me, Shane, like, I suppose gone are the days when a corporate would look to sort of implement a single banking structure with a single bank across the whole globe. So I guess that's throwing some multi-bank complexities into cash pooling and liquidity management.
Yeah, across all of the cash pools that we manage, there is some third-party sweeps linked to all of them. It's nearly impossible to have all your bank accounts with one dedicated bank. Depending on the clients that we manage, some of them have gone very unique, where they'll have a specific bank for each currency and have a ZBA pooling structure there, and then they'll have from that header account sweeping that back to their main banking partner, while other people will have just their header accounts held at their main banking partner and the local accounts feeding directly into that. It does make it a little bit more complex, but we'll discuss that later on when we're going through the benefits and stuff.
Yeah, interesting. So yeah, even on the multi-bank basis, it's still obviously the physical sweeping that we're seeing as being more popular. Yeah. So all of these processes, Eileen, they have to be managed, right? And obviously you're sort of at the coalface of that, being a front office dealer here and sort of managing those structures. From your perspective, what are some of the advantages or disadvantages of the different sort of structures between ZBA and notional pooling, the likes that you see?
I suppose with the physical sweeping from a cash managing daily point of view, I find as a cash manager you're more in control of the flows. You see exactly what's hitting your account, and then it's, I suppose, giving you how you want to deal with that, whether it's invested, and knock on from that, then obviously the actual practical management of it that may trigger swaps, FX swaps on your cash management. Again, like the structure that Shane referred to, the multinational cash pooling, again, that works well from a cash management daily point of view. You get to offset your long positions with your short positions, and that reduces the number of FX that are required on your cash on a daily basis. So that's obviously a main benefit to that, because you're reducing your operational costs and maximising liquidity at the same time.
So it's kind of the hybrid solution has benefits from an operational perspective in that you've got control of the cash from a physical perspective, but then, as you say, when you have the multi-currency notional pool laid on top, it sort of reduces your requirement for swaps.
Does, yeah.
I guess the downside is probably expense, right? It's
yes, it is. It's costly. It's costly to put in place, and but again, I suppose those costs for me, again, as a person doing it on the daily basis, I think that the benefits outweigh the costs.
Yeah,
in my
understood.
Mind.
Yeah, and I think also probably there is an issue with credit with banks in terms of the multi-currency notional pools, in that, you know, they only allow a certain amount of debit credit offset before they get a little bit concerned about the gross debt. So I guess you probably end up managing an element of working capital in the multi-currency notional pool with sort of longer term structural funding in the liquidity swaps. Would that be kind of
that
reasonable?
That would be very true, and reasonable. And I suppose they put different thresholds in place so that it keeps you within the bandwidth that they've kind of applied, and the rules that they've put on you within that. But again, like that, it's reducing the operational need on a daily basis with you know, the swaps and that kind of.
So so really evaluating that, I guess, up front when you're looking at this, you know, from a decision making perspective, and what would work for you in your in-house bank or your organisation in general. You know, probably knowing the end state and how that's going to be managed is probably an important consideration.
It is, absolutely, yes.
Yeah. Shane, you do a lot of work as head of innovation here at FTI Treasury in terms of integrating systems, and obviously there's a huge amount of evolution that's happened in that space over the last, well, the last 5 years in particular, but probably in the last 2 or 3 years, there's been an exceptional growth in that. You know, when you're looking, I suppose, at which system or which liquidity pool might work for you, what sort of integration should you be considering?
If we take a big picture, like usually what you're trying to feed it into is your treasury management system, so that you can track the intercompany loans if you have the ZBA, and then you also want to look at it from a cash forecasting and balance reporting point of view. So, you know, with the ZBA structure, the main things that we need to do, especially if there's a third-party bank sweeps happening, is like, how are they going to be identified in the systems? Because they are, normally on an MTE 940, you will have a CMZ transaction code linked to sweeps within the same bank. But once you go to a third-party bank, you don't have that. So it can be a bit more difficult to get your system to identify that. So you just need to take into consideration that. And then that's for the intercompany loan tracking. And from a cash balance reporting, you know, it's just what file formats you want to feed in with the change now on from the Swift MT940 to the newer versions. You know, is your system able to cope with that? We'll need to monitor that in the next couple of months, because that's supposed to be moving more and more to the new version, I think in the early 2024. So that's very specific to the monitoring of intercompany loans sort of arising from zero balancing. Like outside of the treasury realm, though, I guess if you're making this decision, you kind of need to take into consideration other parts of the organisation. I suppose from an ERP integration and a forecasting system integration. Yeah. So like from your ERP. So like mostly you're hoping to be able to connect through a host-to-host situation where your all your payments are linked to the banking system, where then that's all linked to your cash pool structure. You didn't want that ERP to feed into your cash forecasting as well, so that when you are doing the cash management from a front office point of view, that you have an accurate picture of where you're going to be at the end of every day. And the transferred information between the systems, depending if you have one system covers all. Yeah. Ideally, you have that. Yeah. But you know, as we've experienced ourselves, sometimes it's nice to have a bespoke piece of software for each function, because it can be a bit more customizable to what your needs are. So it's good to sort of have a look at all the cash forecasting systems, not just take one system does all approach sometimes.
So, like, I suppose we've discussed there a number of things, like in terms of common structures, we're still seeing ZBA, zero balancing arrangements, or some kind of physical sweeping as being probably one of the most common deployed, but there are a lot of niceties that can be laid on top of that in terms of the multi-currency notional pools, and in particular interbank sweeping and the likes. I think, Eileen, you would mention that, like, understanding how you want the process to work in the long term is a kind of a fairly essential element of the decision-making process, and indeed how you're going to manage that, be it in-house or outsourced or whatever. And Shane, you've discussed there some of the integration elements that need to be considered between treasury management system, forecasting, ERP, and God knows what else. I mean, there's probably a whole range of other potential systems in terms of FX trading systems and the likes. So to bring it back, to pare it back to kind of the basics, if you were starting with a blank sheet and you were looking at an organisation and trying to define, what would be the best pooling or liquidity structure for them, what are some of the key things that you think, you would throw into that mix?
Cash flow, I suppose their cash flow requirements is obviously key. Number of subsidiaries, number of currencies involved if it's going to be multi-currency, and I suppose just their global footprint. How far reaching are they across?
Like how many banks do their subsidiaries operate in? Are you able to consolidate that into, let's say, one bank per region, or is there local regulatory requirements where you might have to have a local bank account? Is it then able to sweep if it's to the main header account or cash pool? To cut down the number of intercompany loans, some people I've seen setting up like a sub pools below it, so like you concentrate all the sweeps for one entity into one account within the multinational cash pool, and then you can still manage the cash management over that, which works as well efficiently enough.
So it's interesting, both of you there are really saying that understanding the underlying requirements are sort of the key things that will drive you towards what sort of structure would suit you. So really gathering data up front, understanding your currency mix, your jurisdictional footprint, the number of banks you're with and who those banks are, and if there's an opportunity for rationalising, and understanding just the values that are outstanding, I guess, are some of the key things to throw into the mix. And that can really drive you then towards, well, we've obviously got, we won't even go down the regulatory and tax environment, but that kind of plays in on top. I guess the Treasury needs to sort of have a concept of where they want to be before you layer that in. But those sort of elements all need to be thrown into the mix. And I guess it's important to gather that information and define it right up front in a formal way, and then develop, I guess, an RFP for your banks to make sure that you have an adequate and comprehensive response.
And like some of the banks will have different solutions for you, especially with the multinational, as we discussed earlier, the cost for that, the cost range between different banks is huge. Like some of them will charge you both for having positive and negative balances, while others are a lot more friendly. So it will depend on what bank.
All banks are friendly, Shane.
True, but it will depend on the costing structure that you'll get from the RFP. So it's
so defining your requirements, getting a good response from a bank, and being able to do a quantitative evaluation of that really is the process, I guess, to be followed to define your liquidity structure. Shane, you mentioned, well, we've mentioned ZBA quite a lot, and I guess one of the things that we come across quite frequently when talking to clients, and if you're discussing ZBAs or target balances or any kind of physical pooling, is sort of the hassle that the intercompanies that are created as a result of that can kind of bring, and people kind of get a little bit scared off about the level of work that might be required to manage that. What's your sort of view on that?
Well, as long as you have the technology infrastructure, the amount of resources that you have to apply to managing the tracking of that should be reduced significantly. Like, as long as you have good connectivity between your bank and your treasury management system, you should be able to set it up where every morning all your sweeps are identified by the treasury management system straight away and allocated to the correct intercompany loan account. All treasury management systems nowadays will capitalize the interest or calculate the interest on it. So you just need to input all your interest terms that you want to apply to it, any overdraft or limits and penalties, if there is any penalties applied if they breach them limits, and the system should be able to monitor all that pretty seamlessly. As I said previously, when you have third-party sweeps, that adds a layer of complexity, all right, But when you're in the initial process, you just need to be conscious when you're talking to the third-party bank. Do you agree you're referencing on the MT 103 that they're going to send? So when you get it into your header account, it's easily identifiable that this is a sweep in relation to from this counterparty. We usually have something like, net sweep, and then the account number included in field 86 of the MT 940, so that you can tell your treasury management system, if it has that reference there, it goes to this intercompany loan. And that, as long as you think about all that at the outset, it will mean that your day-to-day operations is pretty seamless. And the reporting then at month end, like most treasury management systems, will issue an intercompany loan statement out automatically whenever. So it's
so the solution is there, right? And it's achievable, and it really shouldn't be off-putting for someone to.
As long as you have the technology, it is quite manageable.
And obviously, we provide these sorts of services. So the other option, of course, is to outsource that technology, which means that it's completely seamless. But when that happens, then where does the integration come between the treasury management system and the client side infrastructure, so to speak, in terms of tracking intercompany balances from a balance sheet perspective and the likes?
So, from an outsourcing perspective, once we feed everything into our treasury management system, there's a seamless process then where our treasury management system will create an accounting file or whatever in whatever format they require for their accounting system, and that will be just automatically uploaded into their system seamlessly.
And you would manage all interest accruals and statements and all that sort of stuff?
Yeah, everything is managed here.
Okay.
So they'll just get the end result.
So two options, either internal or external, but both very doable, and shouldn't be things that put you off. Okay, very interesting. So maybe just to wrap up, guys, if there was sort of one thing that you would ask people to sort of beware of when they're examining, what might work for them from a cash pooling or liquidity management perspective, what would be that thing that you would sort of say, look, just be careful of this or take this into consideration?
Yeah, I suppose the costs is the obvious one, and I suppose not to be afraid to go the hybrid model, not to be pigeonholed into one specific physical or notional, that one size doesn't fit all, so be open to customization on it, I suppose, as well.
Keep your mind open.
Keep your mind open,
mine would be to think of the end result of how you're going to get the day-to-day operations of it and how you're going to manage that. Have your technology and know how your process is going to work at the end, and then when you're talking to your bank, you know what you need, what you want, and it'll be easier to design it to correct from the outset without having to go back and tweak it.
Yeah. So keep an open mind, but know where you want to go, kind of at the same time. Yeah. Understood. Okay. Eileen, Shane, thank you very much. That was really interesting to hear your thoughts and insights there. You have to go back now and actually work with managing these liquidity pools. So it's great to have the practitioner's view on these things. And I know, as Shane mentioned earlier, you're managing over 40 sort of cash pools across all these different sort of structures that we talked about. So there's quite a bit of diversity within that. Yet, funnily enough, we see common themes that people should probably be aware of. So thanks again, guys. Folks, thank you very much for taking the time to listen in and to us today in this FTI Treasury Talks. We hope you found it interesting. We're always available for conversations around Treasury issues. As we mentioned, we manage the outsourcing of a whole range of Treasury operations, including, as we discussed today, liquidity pools and cash management for in-house banks and multinational organisations, as well as a range of other treasury services, including the likes of intercompany netting, forecasting, etc. If you'd like to get some more information or get in touch with us, please just pop over to our website, ftitreasury.com, and you'll find a lot of resources there. And as I said, we're always open to a conversation, so please stay in touch. Thanks very much.